As I said, my name is Manda. I call myself the mortgage coach because I combine mortgage advice with financial coaching. Now, one of the questions I got to say, so just say if you have renovated your council property with your own money, so that the council keeps an eye on the spending. I think basically what this client is basically saying is when they get it valued, should they be actually looking, should it be judged on the work that's being done, or should it be judged on the work, on how it should be? Now, as far as I'm concerned, when they're actually valuing your council property for right to buy purposes, they're doing it on the basis of actually as a shell. They shouldn't be upgrading it or valuing it for more because of the work that's been done. Now, as I've said before, I do have a guide that actually talks through what to do when you're getting your property valued. So it is really, really useful to sort of to use that guide. So if you go in the bio, you'll be able to get that guide. The other thing, what I also say is, not only is this a live TikTok and you can ask all your questions, but it's also being streamed on my YouTube channel, and both of them are called the same thing. So it's Manda, the mortgage coach. So you can watch the whole thing back later on my my YouTube channel. And then you can also ask any questions, more here. If you guys know any first time buyers, anybody buying right to buy, anybody shared ownership, any remortgages, anyone who's got kind of mortgage or money matter questions, please share it and let people know. Let people know. If you're enjoying it, finding it useful, please do like it and share it. And as I said, it is going live on my YouTube, so you can, which is of the same name, and you can get you'll get the whole recording of that. So the next question is, will the council request an EPC? Now, when it comes to an EPC, I'm not sure is you know what it is. So basically what EPC stands for is energy proficiency, so energy performance certificate, and it is rated depending on the property. Now, when it comes to having that property right to buy, you definitely do need to get an EPC. If you're selling, you need to get an EPC. If you're applying there are certain mortgages called green mortgages, and if you've got an EPC of A, B or C, you can get a green mortgage. So sometimes the rate is more favorable when it is a green mortgage. Right. Do lenders prefer... Right. Hello. Hi. Do lenders rather personal, do they prefer personal loans or credit cards? I need to refinance my car and apply for a mortgage. Yeah, I would definitely, when you're applying for that's a really good point, actually. Car loans, they really don't like those. They much more prefer personal loans. Now, when you're looking at affordability, when you're actually looking at the personal loan, they actually take into consideration, one, how much you owe on the personal loan, and two, what the monthly payments are. Now, with a credit card, yes, they do look at credit utilization, and that is the difference between the credit limit and the credit balance. But there are with the credit cards, as long as you've been making the monthly payments and everything, you can assume that that a minimum payment's being made. So normally the balance on a credit card and the balance on a loan, even if it's the same amount, the credit card you could be paying less per month, which would obviously increase your affordability. Okay, thanks for that question. The next thing is, we were talking about EPCs. So with EPCs, they range from 8 and 10 on which one you get, will make a difference when it comes to mortgages and things. You'll get Section 125. Now, in between, before you get the Section 125, they will be sorting out your EPC. So normally they would organise someone to come in and do your EPC. I've already purchased it and you're on a right to buy mortgage, because are you planning, and the second property, are you planning to live in that second property? Because there's a thing called a right to buy, let to buy, which I've done for quite a few of my clients. And as long as you're past the pre-exempt period within the right to buy, you can actually convert that from a standard mortgage to a buy-to-let mortgage, and you can sometimes actually borrow additional money from that property, and it's based on rental income rather than your own, and then you can buy a second property that way. Or are you talking about living in the right to buy and buying a second investment property? It'd be quite interesting to know, because there's several ways of doing it. If it's the latter, then what you would do is you would, as long as you're part, you can apply for other mortgages. First property, whichever property is based on the buy-to-let will be based on rental income, and then whichever property is based on the you're living at will be based on your income. I hope that helps. Okay. It's been 6 years till a credit card is removed from a credit file. Is that from start or close? Right, so it's from the close. So if your credit card has been, even if you open the account, it could be running for 20, 30 years. So they're not going to take it off while it's still active. As soon as it's on that closed section, yes, it will be removed after 6 years. Yes. Oops. Yes, purchase it. Second one, planning to live in. Yeah, then it's a let to buy strategy. I love doing these, if I'm honest with you. So please DM me and I can definitely help you. But the figures we'll need is, 1, it's got to be out of the pre-exempt period. 2, we need to know the market value of it. 3, we need to know the potential rental income of it. 4, I need to know the mortgage balance. Then we can calculate how much you can get out of that property as a deposit for the next property, and then we can actually look at what you can afford to buy the next property at. But it is a great investment, because at the end of the day, you could borrow an additional 45% from that property, as long as it's supported by the rental income, and actually use that to invest in another property. If you want, I have a whole presentation on the let to buy right to buy. In fact, I created a workshop that I was planning to run. So if people are thinking of buying their right to buy, and then after the pre-exempt period turn it into a rental property and buy somewhere else to live, that workshop is definitely for you. So DM me and we can talk. Do you need a mortgage broker if you're buying direct from the developers? To be honest, most of the developers will have their own mortgage advisors that they're putting in the mix. But I would always, shall I tell you why? And I don't say mortgage broker, because the broker just does the deal. I prefer mortgage advisor, because we give advice and we help people with their understand how their budget works, how it all works, and you give a holistic service. So that's why I always say mortgage advisor. But when you're going to a mortgage advisor, they have, like, for example, myself, I'm directly authorized, which means I have access to the whole of the market. And because I have access to the whole of the market, I can have a look at high street lenders, banks, building societies, specialist lenders, if you've got adverse or anything along those lines. So we can actually look at what the most competitive deal is. It's not always just down to the rate, because sometimes you can have an amazing rate rate, but the booking fee that you actually pay the lender can be horrific. I mean, I've seen some like 7,000 and more booking fees just to get a decent rate. So you need someone who knows what they're doing, who can, we call it sourcing the best deal for you. And that is why a mortgage advisor is really good. And you want a mortgage advisor that is going to hold your hand and explain everything so you can make an educated guess. I remember when I bought my first flat, I had a mortgage advisor from the bank. I just went directly to the people that I had my current account with, and they didn't give me any advice. They just said, this is the best deal, off you go. And they were a proper mortgage broker rather than advisor. And I didn't have a clue what was going on. And I went ahead and did it. And obviously I was glad. I was kind of relieved because I didn't think I'd get a mortgage. So I didn't ask a lot of questions. But at the end of the day, it wasn't the best for me. And I did find later on down the line that I was kind of stuck. So I was glad that I'd only done a 2-year fixed, because then I was able to move on. And what I mean by a 2-year fixed is the deal that you've committed to is only for 2 years. But they had me commit to, so I think having a mortgage advisor who can give you a holistic is really, really good. Okay, next. They get a little bit confused. You never really need more than sort of 2 current accounts, one for, you know, your salary coming in, and the other one maybe your bills going out. If you are self-employed or you have something like that, you might want a separate bank account because of a different income stream, but then you may want a business bank account. So yeah, it's best to kind of that up a bit. By all means, DM me, as I said, because I'm a mortgage coach. I do financial coaching and mortgage advice, so I can review it on a case-by-case basis and tell you which bank accounts you should consider closing. What I wouldn't do is close the oldest bank account. You may have a bank account that you've had for donkey's years, there's no money in it and it's sitting there. Start using it. Do not get rid of your old bank accounts, because they like to see that you've had a bank account for a certain amount of years. So a lot of people, they have old bank accounts, you know, that they used to have to use, and then they have these online bank accounts that are newer. They get rid of the old ones and keep the new ones. It doesn't look good because it doesn't show enough history. They like, you know, if you've had a bank account for say 10 years, they really, really do love that, because then it shows that you've been managing you know, your money a lot longer. Right, so mortgage prisoner. Okay, oh, I'm really sorry to hear this, but again, prisoners, that is when you're stuck in a more advised, and now you're trying to go on to capital and repayment. Now the difference is when you're on interest only, you are literally just paying the interest. So you've got the outstanding capital that you owe, but you're only paying the interest. So at the end of the term, you still owe the exact same amount, because all you've done is the interest. Now a little tip for mortgage prisoners is I would suggest paying part and part. Now what part and part is when the most of what you can borrow would be capital and repayment, and then the additional would only be interest only. And at that point you are making a dent into the initial loan, the principal loan it's called. And as you make, and even if you can try and make overpayments on that, because it's now on a fixed rate, it's a lot better than some variable rates at the moment are absolutely ridiculous. So it really, really is difficult. So what you can do, work on that. So you have defaults in 2022. Yeah, when you have defaults, there are some lenders that will lend you, you know, there's the 36-month bracket. So you've got 12 months ago, 24 months ago, it looks like you'll be in the 36 months ago, depending on when in 2022 it was. And then you can work on it. At the end of the day, when you're looking at the part and part, so part of it is capital and repayment and part of it is interest only, you could consider doing that, and looking at possibly people who are a little bit older, do more personal questions than I would do online, and then we can sort of get to the bottom of it. And Can you get more? Starting a new job, and I loved a house loan is for these situations. If you found a property and you haven't got time to get the mortgage in, but you should always have an exit plan. So with the bridging loan, yeah, definitely, by all means, the way that would work when you're doing a bridging loan, it's literally a maximum of 12 months, and the interest rate is incredibly high. So the likelihood is, if you can afford a bridging, you can definitely afford the remortgage, because the interest rate is going to be a lot lower. When it comes to a new job, yeah, it depends, because if, and I've said this before on other, you literally are, either just left school, just left uni, just left college, and you've got a new job, like, then the likelihood is they will give you a job based on your job offer letter, or and